Black Monday, October 19th, 1987, the Dow Jones Industrial Average fell 22% in one day, its largest drop ever. A year later, when people were still uncomfortable with investing, the Asset Advisory Group began. October 1st, 1988 was my first day as a sole proprietor. And as we get ready for our 25th anniversary celebration, I've spent some time looking back on how much has changed since then. Some of it good, some of it not so good. The first is technology and its impact on investing. Back then, when I was preparing for a client meeting, I would go to a client file, pull out their most recent statement to see their total number of shares held, go to the Wall Street Journal we would receive that morning to find out what the share price was for their investments, and then multiply out the value for each and every one of their investments held. Then my assistant would use a word processor and type up a summary of all their holdings. Then I'd use graphic software to prepare an asset allocation summary. That was just to get ready for a meeting. Hadn't even done any analysis yet. Today, we push a button and all of our clients' information is downloaded onto software at our desktop. We can see what activities occurred, how they're allocated, what their holdings are, cost basis information, and we can spend a lot more time on helping our clients, meeting with them, making financial plans, and less time on just compiling the information. So that's been great. But there have been a downside, two things I think, especially for the general public, from all this instant access that technology's brought. First of all, when people are able to access their investment information on a 24/7 basis, I think they feel more compelled to do something. So if you are checking in on your investment holdings on a handheld iPhone on a daily basis, you're more likely to want to sell out of something that isn't performing well and buy into something that you think is doing well. Basically, sell low and buy high, and do that more frequently. And Schwab and others have researched, and they've done studies that have shown that the more frequently people trade, the less likely they are to have a positive investment return. You add taxes and trading costs onto that, and it just makes it worse. Especially if we go through a period like the Great Recession in 2007 to 2009, when people felt far more compelled to trade driven by emotion, and having their investments in front of their face 24/7 didn't make it any better. The other thing I've noticed is back then, companies sent out 401k statements, for example, on an annual basis because they simply didn't have the technology and the resources to allow people to have access to their 401k accounts, again, online 24/7. And people were generally more happy about their investments. Why? Because if you take a whole year before you look at your investments, number one, you're more likely to have a gain over a 12-month period than you are a day-to-day period. And then behavioral research in finance has shown that the more frequently people look at their investments, the less happy they are with them. Why? Because for every drop in your portfolio, that causes emotional pain, even though we're not conscious of it. You may get a lift when your portfolio does well, but this lift isn't enough to overcome those drops, even if these are smaller. And so we'll find sometimes at the end of the year, people are surprised to find that they have significantly positive investment returns because all they remember and all they have felt is all the drops. And really, they've had a positive gain. So that's really been an impact on people, that frequency of reporting. The second area I think that's changed a lot is employment and financial security. In the late 80s, most of the people that we worked with had at least a somewhat of a defined pension plan, defined benefit pension plan, and they were receiving a monthly payment in retirement, or their employer had fully funded their retirement plan. And some had worked at the same company since they were graduated, so for over 30 years they've been there. Today, most people, number one, aren't with an employer for more than 2 to 3 years at a time, so they can't rely on their employer for financial security. And even the number of companies that provide a defined benefit plan or fully fund retirement plans are dwindling. So it's up to each of us to be responsible for our own financial security. Back again in the day when people were having those plans funded by their employers, they felt that they could live off everything that they made because the employer was funding their retirement. Today, people need to plan and live on less than they make and put the rest away for their own financial security. So it's a big difference. The other change has been the access to information. People have so much more information available to them than we ever did. Internet service providers didn't even exist, commercial internet service providers, until the late 80s and the early 90s. We had big Morningstar spiral bound reports and value line investment surveys, or we went to the library to get data. And most personal finance information came to people from resources like Money Magazine and Kiplinger Personal Finance. So today you can Google anything you want, and the Google founders hadn't even met each other on Stanford University's campus until 1995, so we couldn't Google anything. I think overall, this access to information is beneficial to people. You can research investment advisors, for example. You can look up people on the SEC website. You can see if there have been any complaints filed against them. You can look at their blog, articles they've published. On the investment planning side, you can use Yahoo Finance to research things. And you can purchase life insurance policies by comparing, researching, and buying your policy even online. You couldn't do that then. And finally, personal financial information. You can access all kinds of calculators online to see how much you should be saving, how you should be saving for college, etc. The downside to all of this, though, is that most of it is written for the general public. So they have to generalize in their advice, and they have to use rules of thumb. And so it doesn't fit people's individual circumstances. And sometimes it can be extremely detrimental, like when it comes to savings rates or withdrawal rates from retirement plans. All that data can be overwhelming too, because inevitably you'll find different sources that contradict one another, and you're left with wondering who is right. So, at the risk of sounding like my grandparents, who used to talk about how things were back in the day, a lot has changed over the past 25 years since we began. Technology, employment security, access to information have all changed the way we approach personal finance. And we're here to help you sort through all of that. And by the way, as a side note, the Dow Jones Industrial Average is hovering around 15,500 today. And while that should only be a very small piece of your overall investment portfolio, I think it does illustrate that the last 25 years haven't been all that bad for people who have a long-term investment plan and can stick to it.